Good evening. Hi, everybody. Thank you so much for coming in tonight. I just want to introduce everyone very quickly. Maybe we could have a bit of around the room, get everyone to say who they are, what they do. Tonight's all about first home buyers. We've got a great group of people here. Really special to have Dan Hearn from Kainga, who's made a bit of time for us to come in tonight. Kate Chivers from Principal Solicitor at Hopkins in Takapuna in Auckland. Tyson Walker from Property Real Estate down in Wanaka tonight. And Rupert Gough, our CEO and founder of MortgageLab. And myself, of course, Brett Davies. I'm based on the North Shore in Auckland. Kate, we'll start with you. Maybe just a quick rundown on, what you are, who you are.
Well, you did it so well, Brett. So, I'm Kate Chivers, and I'm a property lawyer based on the North Shore of Auckland. I specialise in getting people into their first homes and then on selling those homes when you're ready to climb the ladder. That's me, really.
Thanks, Kate. Tyson.
Welcome. Oh, thanks, Brett. Welcome. So I'm the managing director and co-founder of property.co.nz, and we're New Zealand's first online real estate agency that you can complete online auctions, tenders, and online negotiations through our purpose-built platform. And we're a national brand. I operate from Wanaka, but we've got about 35 staff situated from Auckland through to Dunedin. And our commission rates are running at about 1.75%. So not a bad rate for people that want to buy and sell.
Great. Thanks, Tyson. Dan, thank you so much for coming in. I really appreciate you here tonight. So, a little bit about you and Kainga, if you don't mind, please.
Sure. Thanks, Brett. Kia ora, everybody. I'm Dan Hearn, and I work for Kainga. Kainga formed in 2019 from Housing New Zealand, and also a couple of other companies, Kiwi Build and HLC in Hobsonville. And so I started work at Housing New Zealand in 2006, and I've worked in the home ownership area since then. I've been working with the Welcome Home Loan, which is now called the First Home Loan. I'm also involved in the First Home Grant, and also have quite a lot of involvement with some of our other home ownership products, such as First Home Partner, KiwiSaver, withdrawal determinations, and those are the main ones. So and the home ownership team, very, very passionate bunch of people that are really keen on providing as much assistance as we can for first home buyers and also previous homeowners, people that may have owned a home in the past but don't own a home anymore and maybe might be struggling to get back into the property market. So that's what I do.
That's great, and hopefully we're going to touch on quite a lot of the products that Kainga offer, which is really important for first home buyers or second chance home buyers today. So let's Rupert.
So I am Rupert Gough. I'm the CEO of MortgageLab. So MortgageLab is 24 mortgage advisors around the country, and obviously we're quite passionate about first home buyers, getting first home buyers into the market. I wrote a book a couple of years ago, The Successful First Home Buyer, which is really about a step-by-step method for getting into the industry, into the property ladder. So I'm really glad to be here. Thanks, Brett.
Thanks. Okay, so maybe we should just carry on with you, Rupert, because maybe having a bit of a chat around the CCCFA, interest rates, things like that. Is that a good place to start? Does it really matter where we go?
Yeah, I think so. Yeah, I mean, look, the number one thing is the number one takeaway at the moment is that the market at the moment is not the market it was 12 months ago. In fact, it is almost the exact opposite. It was a steaming hot market you could get finance, but it took it took us 12 days to get an answer from the bank. And now that the heat has been taken out of that market, and I think I blame personally the Triple CFA, which is the Credit Contracts and Consumer Finance Act, and that basically put a handbrake, or probably more accurately, a brick wall in front of the bank's lending capabilities. And look, it's not the bank's fault. It is they were following the rules, and but essentially, as an example of how the Triple CFA affected the lending in November, when it came in 1st of December, but the banks were implementing it prior to that, a couple of months prior to that. There was a time when advisors were turning away clients who, turned up and tried to get a mortgage. We were saying, look, you're not going to get it under these current rules. Of those filtered ones, 70% of those were then being declined by the bank, right? So you can see how suddenly everyone's enthusiasm for borrowing and therefore buying turned off really suddenly. Now, the good news is that 7th of July, those rules flipped back a little bit, I would say mostly, to being able to, for the banks to take a more sensible approach to lending, in that, whatever you've spent in the last 3 months isn't necessarily what you're going to spend once you get a mortgage. We all know that, people who are renting tend to buy more coffees and avocados and drinks and things. But if you've got a mortgage, you tend to prioritize your mortgage first because you want to remain in your house. And that is the sensible approach. And the banks now have the freedom to sort of think about that a bit more. There's a whole lot of other stuff around savings that they had to forecast for expenses. But realistically, the takeaway is Triple CFA killed the property market in November to December last year. And I would expect that to start cranking up. You're not going to see 30% capital gains again. Don't worry, it's not going to get that hot again. But I think you're going to see things start to come on. And I think probably, Tyson, if you want to jump in on what you've seen in the market from that.
Yeah, well, I think, Rupert, I concur with your points around the Triple CFA putting the handbrake on the market. We, if you wind back into sort of 2021, we had some of our staff that were more like security guards or marshalling people down the street for first home buyer territory, trying to make sure that everyone could get into the open home and have a fair look at the properties. And we were getting so much heat, many offers coming through, and a lot of people getting quite disheartened by the whole process. And then all of a sudden, the Triple CFA comes in, handbrake comes on, and if I'm talking to some of my team now, they're getting very few people through the doors. But we are starting to see signs of green shoot activity and much more people looking in that first home buyer territory again, which is really nice to see. And probably the heat that was driving some of those pretty chaotic sort of prices sort of coming back to a more of a normal level.
Yeah. Sorry, Dyson?
Oh, no, I was just sort of quite interested in sort of where we go with this market, though. So what I was thinking around is that whether these Triple CFA alterations that Rupert mentioned are going to be quite a change in the landscape. Personally, I feel like we might just have a bit more of a gradual take off again, and not this just because of a bit of a change in legislation. We're going to see these heady heights again. But it will be an interesting.
There's a bit in that. It's a bit in that the one real axe that was hanging over the bank's head was that the directors were personally liable for the bad lending, and not a liability you could professional indemnity and insurance cover your way out of. So they were literally out of their pockets, and that hasn't been removed yet, although it's kind of still in front of the government. So it's not going to get back to heady, right? And of course, we've got interest rates, which are now no longer at 2.2%. So, which is exactly what higher interest rates are designed to do, right? Is cool the market.
Absolutely.
And I think you're right there, Rupert, as well, with the serviceability for these first-time buyers as well. With the increased interest rates, there's still going to be certain breaks or headwinds in the market, even though there's been a lenient or a lightening up of the CCCFA. I still think that there's probably a lot of headwinds and obstacles still out there.
Yeah.
Well, one of those obstacles is a lot of banks aren't wanting to do high LVR lending at the moment. So in fact, pretty much all of them. So,
which is where the first home loan comes in.
Yeah, if only we had a government scheme.
If only. Yeah. Well, funnily enough, we do, and there's been some important changes as well to the first home loan scheme. So perhaps I can go into that a little bit as well. So the first home loan scheme was used to be called Welcome Home Loan. It's been around for a long time, since about 2003, and it's always been a low deposit home loan. And at one stage it was no deposit, and it's fluctuated between 10 and 5, and now it's 5%. So what it does is it provides certain lenders who have signed up to the scheme with Kainga Ora are able to offer just a normal mortgage, like a normal housing loan, same interest rates as all the other loans, but with a 5% deposit. And those loans are insured, not guaranteed, but insured by Kainga Ora. That means that if the person defaults, Kainga Ora will pay the bank if there's a loss. So effectively, it's the same, the same sort of loan as they would get from any other bank. But they pay. They only have to provide 5% deposit, and they pay a 1% premium on top of whatever loan amount that they're borrowing. And so the real benefit to that is obviously they get into home ownership quicker than they otherwise would, and they can also use other Kainga Ora products in conjunction with it. So they can apply for a first home grant as well, and also use their KiwiSaver with their KiwiSaver funds as part of the deposit as well, and that all comes off the 5%. So the first home products like the first home grant, first home loan, and also first home partner, which I'll talk about a little bit later, they're all designed for first home buyers, people that have never owned a home before and currently don't own any homes, or if they've previously owned a home but they no longer do so. And you mentioned second chances before, so that's second chances is a way of describing those sort of people that are basically someone in the same position as a first home buyer in terms of assets. So someone that's not sitting on a 20% deposit in cash in their bank account. And primarily these products are all for owner occupiers. So they're not for someone who wants to buy a house and rent it out to someone straight away. And there are some of them have minimum ownership and residency requirements as well. So if you buy the house, you've got to live in it yourself. And there's minimum periods that for example, the first home grant, you have to live in it for 6 months. So I think that this, and in terms of the other requirements, there's house price caps for the grant, and there were house price caps for the loan, but they were actually removed altogether in May. And the house price caps for the grant, most of them were increased in May as well, because the uptake for some of those was a little bit lower because of the house prices just in the last 12 to 18 months is going through the roof. So hopefully they're a little bit more in line with with the current prices, but they're always aimed to be aimed at lower quartile house prices. So they're not necessarily for people to buy expensive houses. They're people to buy at the lower lower end, and there are income caps for those as well. So that means that it's people on modest incomes. That's who these products are targeted at.
Dean, just before.
Oh yeah, sorry, Google, Brett.
Oh, I'm just going to step in there just in between because we really want to. It's a really great opportunity for anyone listening. If they've got any questions, so please just type away. Ask what you like. This is a great opportunity to get those questions answered. Sorry, Rupert, to interrupt you.
Well, so that's the big one, right? Is that 150,000 is a reasonable household income, especially with that change. So that, very loosely, I mean, no one quote me on this. This is not personal advice, but that would typically get you about 800,000 if you budgeted and didn't have a lot of debt of borrowing, right? So you're talking 800 to 850,000 purchase price if you're right up the tippy top of 150,000 income. And so now that there's no price caps on the first home loan, no geographical price caps. So theoretically, in I don't want to name a single town because I don't want to be get in trouble, but in the smaller provincial towns, you could buy a house at 850,000 with a 5% deposit. So call it 800,000. You need 40,000 deposit. If it's a new property, you'd get the first home grant of. If you've both been in KiwiSaver for 5 years, you get 20,000. So you need 20,000 your KiwiSaver, 20,000 first home grant, $800,000 new build house. That is phenomenal, right? And I think people don't appreciate how achievable that is, particularly with the latest round of changes. I think. I mean, Tyson, 800,000 in some of the smaller towns. That's doable, right?
Oh, it's absolutely. I mean, it doesn't really even have to be in a small town. I mean, we've got lower property prices in on the outskirts of Canterbury, Christchurch, for example, or into sort of provincial Timaru, and some of the smaller provincial towns in the North Island. 800,000 or thereabouts, could get a substantial property, even if it was lower than that. Even if it was sort of in the 600 realm, you could get a nice quality warm. And I'm quite into the warm and dry, making sure that they're comfortable homes as well for a reasonable price. So I think congratulations, to the lawmakers around this, because I think it's just making it so much more affordable.
Yeah, we do have a question. We could jump right onto that.
Yeah.
Oh, look at that! Look how good this software is. How much stock does Kainga have? So I gather they're talking in this instance about Kiwi Build. Would that be your field, Dan?
Yeah, it could be. Although when the question could mean, are Kainga selling houses of our own? And the answer to that is we're not selling our own stock in terms of the houses that we're providing to tenants. In some very rare circumstances, we do sell some houses to tenants, only about maybe 20 or 30 a year, not a huge amount. And those people are only selling them to the tenants that are living in the homes themselves, and only if those people can go through the process of getting a mortgage. And so in terms of the stock Kainga have, so that could mean that. Could also mean Kiwi Build as well. And that's more in the hands of the developers, because Kainga's role in Kiwi Build is to assist the developers by providing an underwrite, which means that we get into a deal with a developer for land, for example, and we come into an agreement to say, well, the developer can sell so many of these houses at affordable prices that are capped, and if any of them don't sell, then Kainga agree to buy them back off the developer. And so that's the first part of it. The second part is working through the eligibility process. And that's the same way as we assess, say, first home grant applications. So people apply and they provide their income details and they sign a declaration to say that they don't own any homes and that, they're first home buyers or they're previous homeowners. And if they're eligible, we'll give them an eligibility. Then often the properties that come up for sale by the developers, we'll talk to the developers and decide the best way to sell them. Often because of the demand, the best way to sell them is by ballot. And so at a certain time, we will work with the developer and advertise those properties for sale and run a ballot for maybe a week or 2 weeks and send out notifications to anyone that's been interested in that area, for example. And then once the ballot closes, anyone who's eligible for KiwiBuild that can enter those ballots. And then those ballots are drawn and we pass those details on to the developer and they work with them through that. So that's sort of Kainga Ora's role. We're not involved in necessarily building the houses. So we do have our own developments, but we don't necessarily sell them as part of KiwiBuild. But
I think probably an important takeaway is that the first home loan, first home grant isn't just for KiwiBuild or Kainga Ora houses. It's for anything that meets the price criteria.
That's right.
So even if there's no KiwiBuild houses available, the first home loan, first home grants still count.
Correct. Yeah, absolutely. Yep. Very good.
Dan, what's the process for a customer or for a client to buy to enter into a ballot for a KiwiBuild property? Do they have to be pre-approved?
Yeah, they do. Yep. So there's a portal which is opened from the website, and they go into the portal, enter all their details, supply some documents. They need to get some of those documents signed, witnessed by a JP or a solicitor. Their declarations to say that they are who they say they are and that they are first home buyers. Then once they're eligible, then they can enter. The eligibility lasts for 6 months, and during that period they can enter as many ballots as they want to anywhere in the country. So I mean, we do have people entering ballots from areas that they don't live in. Some people relocate to different areas. Aucklanders, can perhaps buy houses in Rotorua and other places like that. So that's how it works. They need to be eligible first. But once a ballot is open, if people apply during the period the ballot is open, they can sometimes be approved. We normally say we need at least 5 days to process their application. We can do it quicker than that at times. So we have had people apply for eligibility while a ballot is open, and they have achieved eligibility and have managed to enter a ballot before it closes.
Does that include lending pre-approval?
It doesn't, no. So, but we do recommend that they do have lending approval, because if they win a ballot, often the developers want them, they negotiate with them. They've got 5 working days after they win the ballot to negotiate with the winner of the ballot. And some of that negotiation could mean that they need to be pre-approved with finance. And so if they haven't been, then sometimes that might mean that they aren't able to proceed with the purchase. So we'd recommend that they do get pre-approval first with the lender.
So quite an important aspect of this is withdrawing KiwiSaver, which we could segue into Kate here, because getting KiwiSaver out in 5 days can be done. But how does that work, Kate?
It can be done. Very, very rarely is it done in 5 working days. So what would happen is we would help the client do the applications, sign the declarations, and then send it to the provider. The provider then assesses it to make sure that we've met all our undertakings, which mean that we promise to hold on to the money until settlement, or if it's being used as a deposit, that we have an agreement with the vendor's solicitor that the deposit won't be released until such a time that everybody's able to settle on the property. So in terms of timeframes, you're looking most banks or KiwiSaver providers will say, give us a minimum of 10 working days, which kind of fits in with the finance aspect of the sale and purchase agreements. But there's very few that would come back within 3 or 4 working days. The main banks, for instance, they'd like, 10 to 12 working days to get this processed. And I think that that's just a reflection on the staffing issues that the banks have got. Just like everybody else, we're struggling for staff, and it's hard, their processing times, just like finance, I imagine, is still slow. My advice is as well, if you're going to use your KiwiSaver as a deposit, then talk to us, talk to your lawyer about structuring the sale and purchase agreement, so everyone knows that if the agreement does come and become unconditional, there'll be a longer time frame for you to pay the deposit, which all goes together with, obviously fits together with the finance clauses and the other things that are on an agreement. If we are talking a new build, with developers and development clauses, they take a lot of time, and far more time than an established building, to actually go through from a legal perspective and fully inform the client.
And so there's a lot more that you need to do. Of course, you don't want a brand new first home buyer rocking up to your office going, we've got a sale and purchase agreement here, can you help us? Because you really need to do a little bit of work before that, right? So
certainly,
maybe you could take us through.
Yeah, from my perspective, generally it really helps if the mortgage brokers and the solicitors work together as a team. For pre-approval, if the mortgage broker is taking a client through pre-approval processes, onboard themselves with the solicitor, so we all know what's happening, the property that they're looking at, and then we can formulate a plan to move forward. There's nothing worse than, and it was happening certainly last year in the FOMO stages, where I had some first home buyers. It was heartbreaking for them because everything was auction, so you had to do that whole due diligence prior to them even making a bid, and 90% of my clients were being blown out of the water by the first or second bid at the auction. So there was a lot of time and frustration in that. But having the relationship with your mortgage broker and your lawyer, and knowing exactly what's involved in the process from the beginning, and if that means using, applying for Kainga loans as well, we can help you through all of the steps, all the way through till settlement. And we're on your side at the end of the day. We want you to get into your first home.
Yeah, it's very, very important that you sort of work on that whole triangle, really, between solicitor, the broker, and also the real estate professional, because what I concur with Kate as well, is around the heady days of those auctions. It was quite difficult to actually just hold first home buyers back, because they're sort of wanting to bid and they really want that house, but they really hadn't got their ducks in a row. So getting those ducks in a row, really, really important. And these days, like I'm telling my staff to always talk with the purchasers, understand whether they really truly have that deposit locked and loaded, and try and line up our finance clauses with the other clauses that might need to be inserted in a contract to make sure that you can settle and transaction go through. So
yeah, and I think it's important to note as well that just because you've done one house and you've been through the process with one house and it fell over, doesn't mean to say that the next house will be the exact same process, of course, because you've got different type of property structures. You've got freehold properties all the way through to apartments and body corporates, and each one will have a separate set of rules, if you like, or guidelines that the banks follow for lending. And I know that that's MortgageLab's domain, but there's also different title encumbrances and things that need to be considered, residents associations and things like that might actually up what the repayments you have to make over the property. It's not just the serviceability of the mortgage, but the rates, and then any residents associations or body corporate fees that would need to be taken into account.
Yeah. And a lot of the problems that we were having last year when those prices, the house prices were, getting up and there was a lot of competition, is that if you missed a property, and more so for first home buyers who are restricted on cash to, everything's gone into their deposit, they miss out on that property. They've done all that due diligence on it. They've spent a whole lot of money with their lawyer, right? And then they've got to go to the next one. So it's a really...
And when the market was loaded that way for auctions, but it was awful. What we've seen now, and I don't know if Tyson agrees, is that there's a lot more for sale by negotiation now, which means that we can get an agreement in place and then work backwards from the agreement rather than trying to do everything up front. And again, from your own perspective as the mortgage broker and Tyson as well, back in the FOMO period that we've just gone through, the amount of people and the queues of people that were literally rocking up to want you to do, the due diligence by magic. Literally, I had properties that were coming on the market on the Thursday, and on the Thursday night, they were already going to a multi-offer scenario. And I mean, who can do due diligence during a couple of hours? I mean, it's just not, it wasn't realistic and it wasn't sustainable. And so certainly now for a first home buyer, I think there's far more opportunity to negotiate and get things right from the outset, which is good.
I think Kate, I think it's a much more level playing field now, much better field for a first home buyer to come in right now, because like you say, the auctions have waned away. We've got a lot more stock that's by way of negotiation or got a price on it, and you can do your due diligence with your lawyer and feel comfortable going into that transaction. So I think it's actually a really nice period that we're moving into for first home buyers in particular to try and find a property that actually suits their needs, and not just rushing in and buying the first one and finding out it's sort of, it's damp and it's wet and it just doesn't suit their needs, but they just jumped on it because they had to jump on something. Now it's a much nicer sort of feeling to the market, I think, for first home buyers.
Yeah, that's great. Hey, I think we're getting a few questions, and so Rupert, do you want to just
we
kick
sure are. And so I've got one from Rob, but I'm not going to put that up. I'm going to come back to that because it's a real juicy conversation that he's asked. So he's asked it over 3 comments. I can't put it up. It's a great one. But we might just pop back to Kiwi Build Homes just for a second. So Dan, the question was, do all Kiwi Build homes go through Kainga Ora? Seen some through Fletcher's. So how does Kiwi Build work for that?
Yeah, well, I explained a little bit before about how Kiwi Build works, how we work with developers. Now, some developers offer their own stock for sale, and in a complex, there might be some that are sold under Kiwi Build and some that aren't, and they might be sold at different price points. So, and the question, do all Kiwi Build homes go through Kainga Ora? Well, if they're sold under Kiwi Build, then yes, they do. Yeah. So So and Fletcher's is one of the developers that we have worked with, but Fletcher's have their own stock that they sell, some of which are Kiwi Build and some of which aren't. And the way I described how Kiwi Build works before, for those that might have missed it, first of all, we work with developers to facilitate the construction and of affordable homes by underwriting some of their stock. So we offer to buy some homes which they can't sell, and the second part of it is working through eligibility. So making sure that any buyers of Kiwi Build homes have gone through the eligibility process, and then if the demand is great, then we run ballots to make sure that it's a fair process for anyone who is eligible, wants to enter a ballot, that they have as much chance as anybody else that enters that same ballot. So that's kind of where we, what Kainga Order does.
We've had a couple of clients win ballots. It is like winning the lottery. You get a substantially larger house for the price. Yeah, it's quite amazing. Yeah. Do you know how many Kiwi Build houses are out there at the moment?
I don't know how many are at the moment, but we do have a pipeline. So I believe there's none. We've just finished a ballot actually in Silverdale and just near Whangaparoa, so kind of further north than the North Shore. So we had about 37 homes there, and there's more in the pipeline. So there's none on the website at the moment, but we there's a constant stream of stock that's being coming through. So I don't have any specific numbers at the moment, but for any eligible or anyone who wants to inquire about Kiwi Build, you can go onto the website kiwibuild.gov.nz, and you can actually register your interest. And so anytime a development comes up with any properties for sale, you can select the area that you want, or you can select every single area if you want to, or all of New Zealand. And whenever property or properties come up for sale, whether it's by ballot or by direct sale, then you'll be notified. You get a little email message to say that that's happening. So anyone can do that. You don't have to be eligible. So us as professionals, some of us have probably registered interest on there just for our own interest. I know I have.
I was just thinking about doing that.
Yeah, do it.
All right. Can we talk about this question? So this is from Rob. So he is he's in Wellington, and in order to get an affordable property, he's looking at company share properties, which I assume is a company share apartment. I grew up in Wellington, so I suspect it's either in Thorndon or Orange Bay, because that's where they all are, I think. He said, look, there's only 2 banks lending on it, and they will they require a 45% deposit. And he just wants our thoughts on, is it a good buy? What happens later when they go to sell it? So first of all, this will not be personal financial advice, but I think there's some good thoughts on properties that, in general, that have quirks about them, like a company share, where you don't own. Oh, Kate, you're gonna have to help me on this one. Where you don't own the unit, you own a percentage of the entire building. Is that right?
Do you know what? It's not something that I've come across that often. And I can honestly say that I've never dealt with one myself in terms of that. But it sounds as though, yes, a company holds the whole of the property and you become a shareholder in the company and you own a stake in the company, which would be proportionate to the area that you actually occupy in the house. That's the way that I would probably describe it, without going off and doing
committing to anything,
research and committing to anything. So don't quote me on that. But
so there's a couple of things. So if the bank is asking for a 45% deposit, they have a view that you are going to have a problem selling it later. From what I know, the ones because I've actually done the same thing, Rob, when I was younger. We looked at getting on the property ladder doing this. There's a couple of quirks. Often these things don't allow you to rent it out. So there is a no tenant clause in there, which means if you get into trouble and you have to move to a cheaper place and you have to put a tenant in there, you have to apply to the body corp or whatever they call it in a company share scenario to get a tenant in there, and they have the right to say no to that, which limits your options. At that point, you have to fire sale it if you're in serious trouble, and that comes with lower prices. without giving you personal advice, I would suggest you see if there are other options in that price bracket. Would be my.
Look, from my experience, if the bank have considered it high risk and they only want, they want a 45% deposit, then you've got to ask yourself, what do the bank know, and what is the bank worried about?
And probably, if you find it pretty difficult to actually purchase the property in the first place, then think about it when you get onto the other side of the coin and you're actually trying to sell it. That may also be quite difficult to find a person like yourself in that situation that does want to buy something like that. So it may have a smaller buyer pool in the future as well. But
and you might want to check the historic sale values as well, and how much it's appreciated over time. I mean, it's not a great record of what the future might hold, but history has got a way of giving us lessons, right?
I'm not quite sure of the situation, but it might be that it's in a wonderful area of town, you see. So it's a way to get into a fantastic location without spending the huge amount to get in there. But
But then when you come to sell it, it would be the same potentially and have the same issue. Are you going to make any capital gains to get the next step up on the ladder to get a bigger place, or the place with, for a family? If it's, you're looking at a 1-bedroom now, are you going to be able to get enough together for a 3-bedroom in 10 years' time?
Good question, though. Good question.
Yeah, it's a real good one. And I could tell by the way you wrote the question, he'd already addressed these kind of potential issues. So, it's really a risk decision for you, Rob, whether you can purchase it, you can be on the property ladder and you may get some capital gains, but there is a risk there that if you need to sell in a hurry or sell in a quieter market, that you may not get the buyers you want.
And you need to check what the rules are and the property. I'm going to call it a property sharing agreement, but it's likely to be a shareholders agreement that you sign up to, and it'll be very much like a body corporate rules or something along those lines, that will tell you how, when, and you can live by the rules of the building.
Yeah, there's a couple of professionals that aren't here that may have an opinion as well. We don't have a banker or a valuer, and they would have opinions on company share and also leasehold properties as well.
I was going to get started on leasehold, but I didn't want to use bad language. I might get my YouTube channel banned.
But from Kainga's perspective, we support if first home buyers or previous homeowners that are obtaining an interest in land or an estate in land, and the company share, we don't consider that to be an estate in land. So, which means that first home grant and first home loan and also first home partner, all of those are off the table, unfortunately, for properties like company share.
But normal apartments are
normal apartments. Yep, absolutely.
And I think there's some dirty maths we can do there, right? So if you need, he's just mentioned that it was say 400,000, so you're going to need $180,000 deposit to get that. Let's say you had $80,000 deposit, or let's make it easy, $50,000 deposit. That would get you basically just over $100,000 company share apartment, which probably wouldn't be the car park. Or with the first home loan, you could get up to whatever $150,000 of income you can afford, so probably $800,000. So your deposit will go a lot further into a property that is guaranteed. Now, of course, this may be all irrelevant if you earn more than $150,000, but just search out those other options, I think.
Yeah, I was just going to make the point about the income as well, which we were chatting about before we went live, is the income assessment. So normally if you go to a bank, they'll be asking what income you currently earn. Now, in terms of the income caps for our products like First Home Loan and First Home Partner and First Home Grant, we're interested in your income in the last 12 months as it appears on your income statement from IRD. So it's all about, so we're in July now, okay? So it's basically from the 1st of July 2021 to the 30th of June 2022, what was your income during that period? And that's for all named purchases. So it could be if you're purchasing on your own, then it's just your income. If there's 2 or more purchases, it's all the purchases. So if it's say a couple plus mum and dad, then that's done on all 4 purchases. But one of the changes that has been made recently is the creation of a new income cap. So previously it was 95,000 for an individual purchaser and 150,000 for 2 or more purchases. Now we have a new income cap which is set at 150,000 for an individual purchaser with dependents. So that's basically somebody who's buying on their own but has children or other dependents to support in the household, and that means that we reflect that their incomes need to be higher because the houses that they're looking at are higher, and so it's basically for people that are on a reasonable income, but they need that income to support their family. But previously they weren't able to access assistance such as First Home Loan and First Home Grant because we said, well, you're a single purchaser, your income is too high. So that's an important change that's been made recently.
Hey Dan, I've got a question for you actually.
Oh yes.
Would that be okay? Yeah.
Absolutely.
So I just wanted to know what Kainga Ora's position is on gifting from family members, not, the bank of mum and dad, so to speak, and whether they would accept a deed of acknowledgement of debt versus a gift scenario for the deposit.
Well, the deposit requirements for the grant and for the loan is 5%, and that can be the grant itself can be included in the 5% and the withdrawal and a gift. But a deed of acknowledgement of debt is not a gift.
No.
So the 5% has to be unencumbered effectively. So it has to be an actual gift, it's non-repayable, and the gifter has to sign our own declaration, which says that it is a gift and it's not repayable. And so that's the requirement. So if it's a debt that's going to be repaid later on sale of the home, then they can have it, but it can't be included in the 5% deposit. They have to have a 5% deposit outside of that deed of acknowledgement of debt. Yeah.
Thank you.
It is a bit of a shame in terms of even those kind of loans that once the property's sold in the future that it's repayable. It can't encompass that, but that's right. We won't beat up on Dan for legislation that isn't your problem.
Yeah, well, that's an important thing to mention as well as Kainga Ora's role, which I probably didn't explain properly at the beginning. Our role is to administer the products on behalf of the Crown. So we receive applications and process them and provide people with the grant money and ensure the loans. In terms of the settings, the house price caps, the income caps, and all that sort of thing, that's done by the Minister, and it's done by advice of HUD, Ministry of Housing and Urban Development. So they're a government ministry. They've got a policy function. They work through all the the house prices, lower quartile, and they're the ones that provide advice to the Minister and Cabinet to say, we think the house prices should be this, and then it's the Minister that decides. We do get a lot of people coming to us saying we think the house price caps are too low and that sort of thing, and and sometimes we might want to agree with them, but Kainga Ora, our role is simply just to administer what the government have asked us to, and they've provided the settings for those products, and we can't, say, well, we know your income's 151,000, so we'll give you a grant or a loan. So we're reliant on the minister and cabinet to provide us with the settings, and we just administer them on their behalf.
And Dan, I think we were talking earlier about these caps and those settings. They are now going to sort of come back to them on a more regular basis, right? And alter those caps from time to time. That's
right. Yeah. So we've got agreement. The minister has agreed to review them every 6 months, which potentially could mean that they go up and up and up, or also they may actually go the other way.
Yeah.
Which will be,
might.
Yeah. So that's something that's never happened since we've been administering these products. The caps have steadily increased, as the income caps have increased slightly over time as well, but we've never had any caps go down before. So if that happens, that'll be pretty interesting.
Yeah.
Cool. We've got a really good question about builders reports, which I think a lot of people will be able to jump in on this one. So this is talking about getting a builders report. So if you get a builders report and you're looking at several houses, which may work, then, and you're not getting these houses, then the costs can add up. So the question was around the order. So I'll start by saying that more often than not, banks don't require a builder's report unless there is a disclosure in the sale and purchase that there is some sort of issue. So a builder's report is a really good thing to get, but often not. Brett, when was the last time you got a builder's report requirement condition?
I can't remember. I think though what's important though from a first home buyer's perspective is to get as much insurance as possible over the property that they're buying. So a builder's report is going to give a good indication of a property, a property's,
Yeah, Tyson, have you got anything to add about builder's report?
Yeah, I was going to jump in there. I mean, I am actually seeing quite a lot of them coming through the ether, actually. And I'm actually quite pro having a building report on most properties. Sometimes the bank will require, they'll come back and want a building report, especially if it's like a monolithic sort of clad home, that sort of territory. But also, I think it, to Brett's point, it sort of just gives a little bit of comfort from the purchaser that there's no real inherent issues with the property. I mean, a building report doesn't safeguard you 100%, but it gives a little bit of comfort and confidence when you're putting together a deal. And most vendors at the moment are understanding that a lot of people are actually putting those clauses into the contracts. So
if I can interject there, my view right now with the market as it is right now would be to get your sale and purchase agreement agreed and have the condition in the agreement to give you the right to do whatever it is you want, whether it's a limb report, a building report, a toxicology report, whatever it is, because every individual that's buying a property will have their own risk profile. Some might be like, yeah, I don't care. And then at the other extreme, somebody will want absolutely everything covered off as far as they can. So put them all down in the agreement. We can always negotiate them out. We can always decide not to go ahead and get the toxicology report. But if it's not in there, then you can't go back and add it in after the contract's been signed, unless you've got a very nice vendor. So I would say get them into the contract and then we can talk about it. But if they're not in there, then you've lost the opportunity.
Yes, that's right. And there's a couple of things here as well, that if a building inspection is in the contract, the bank, we have had instances where the bank sees it in there and says we want a copy of it. So that's when they might ask for it. The question though is it best to get a building report first and then take it to the lawyer or vice versa? I think you guys.
I feel as though I answered that and said get the agreement first and then talk to your lawyer, and then you can decide whether you want to go ahead and get a building report. I've got to say, as a lawyer, and I don't know any lawyer that would tell you otherwise, their recommendation would be to get one. So
yeah. The other point here is that, you know, if you're looking at several houses, although buying a cheaper home looking at a cheaper home in a high LVR situation, probably not sure if I'd recommend that if it needed a whole lot of work when you've already invested all your cash into the deposit and you don't have a lot of money left over to do renovations, because you're not going to get extra lending until your LVR is under 80%. So assuming that your affordability is there even at that point. So,
and I can tell you a bit of a horror story on that one if you want to hear it, Brett. And it was really very much a case of first home buyers buying to their max that they could possibly afford. They did get a building report, but there's always a disclaimer on the building reports anyway. And on this occasion, you know, there wasn't anything physically wrong with the building, but once they'd moved in, the couple found that the gas system, the heating system, wasn't working. They got a gas specialist out, and the gas specialist turned off their gas in the middle of winter and condemned it.
Oh.
And it was a costly mistake. They couldn't potentially afford heating, and as I understood it, the particular people, they were family friends. It wasn't a client relationship. At the time, they ended up with a plug-in heater over that first winter until they could afford to get the gas system fixed.
I
beg your pardon?
You wouldn't want that happening in Wanaka.
No, definitely not. So a building inspection, I guess, isn't just about the bricks and mortar or the cladding of the house and the roof. It's about, you know, making sure the chattels work and that they are safe for use as well. That there's, you know, X-ball under the floor or insulation in the roof to keep you toasty.
Yeah.
Thanks. Okay. What else we got, Rupert?
We're coming to the end of it, but I just love that. Where's the after party? Thank you, Yaka. Yeah. Let's. Does anyone want to give a go at forecasting what the next 12 months looks like on a recorded video? I'm gonna. So
I'd like to hear it.
Yeah, because I write this blog that we have on where are interest rates going the next year, and I basically update it every month because it's wrong by the end of the month. So my guess would be, and I'm talking interest rates here, that and I always talk about the 1 year fixed rate because that's the sort of the cheapest, most commonly used fixed rate, so people can kind of get their head around it. Currently at 5.19 to 5.35. We're seeing it drop a little in the last week. I would think you would probably see a very low 6 in front of that this time next year. There's a couple of OCR jumps which have been factored in, but you know there's also a bit of mess around the world and things, which sucks. 0.7% higher. But if you think about where we've come from in the past year, this time last year we were at 2.2 and now we're at 5.35. So a majority of the pain is already baked in. You're not going to see 2.2 to 5.35, 5.35 to 8.7 or whatever. You know, something's really gone wrong there if we're in that category. So the pain that's already in is your current pain for the next couple of years, I would think. Yeah. Tyson, do you want to give a nudge at the market?
Thank you, Rupert. Yeah, not great to be on record on this.
Sure.
I do. I've been around banking for most of my career as well. So, I do agree with you around interest rates. I think they will rise a little, not huge amounts, and the pain, like you say, is pretty baked in. So I think actually we're sort of steady as she goes now. If I had a chart, I've got one at work that I sort of pull out, but basically, things are ticking along like this, and then COVID came along and it just shot up, and now we've shot back down, but we're still higher than where we were 2 years wind back, and it's just going to slightly keep ticking up. Whether the rate of that tick up is going to be anywhere near what it was pre-COVID will be interesting. I think we're probably going to plateau off. We're going to have quite a few properties that will be coming to market through the spring and summer periods. There'll be some good buying in there for first-time buyers and the like. But I do think in the main, interest rates are fairly much where traditionally they sort of hover in New Zealand. So I don't think we're going to lose the shirt off our backs in the property market. I think we're just going to plateau along, tick up a little bit here and there each year from now on in for a few more years. So that's my prediction. No major big crash that some of the media outlets like to soundbite would be my thoughts on it. But don't quote me.
It's on the internet now, mate. Kate, do you want to give it a go?
Yeah, well, I'm not going to talk about property price rises and interest rate rises, but I certainly see a market for a vendor, in terms of there's going to be far more properties on the market, which means that's great for buyers as well. I suspect there'll be a lot of people reassessing their lifestyles, moving out of Auckland, cashing in, cashing out, and downsizing to smaller, cheaper areas to purchase. So from my perspective, I can definitely see already there's a lot more stock for sale. It's just whether there's going to be the buyers available in terms of the lending available for those buyers to get onto the market. So slow and steady as she goes. I go with Tyson on that one.
Dan, you don't have to make a comment because you work for a government institution. So, but if you're allowed to, you can.
I'm absolutely allowed.
Brilliant! Do it then.
Yeah. I will. I'll predict an increase in first home grant, first home loan, and first home partner applications this year. Even when things were quiet, we did see a reduction, but there were still people achieving home ownership with our products, people that were getting grants all throughout the country, and also first home loans and first home partner, which has been around since October last year. There's been about 40 odd people that have gone down that pathway and purchased homes. I'll predict many more of those this year. So I just think it's, I'm really happy and proud that, we are helping, Kiwis into home ownership. And just really happy to keep doing that. I mean, it's a great job to have, really, when you're sort of paying out sort of hundreds of thousands of dollars of grant money every month to first home buyers, and some of them dealing with personally. So really happy to keep doing that, and keep helping Kiwis with their getting into their dream.
Yeah, great. I think that if any first home buyers are out there listening, or they're not sure about their affordability or their what they might be able to do, they should at least talk to a broker, preferably, and just see where they sit. I don't really want to predict on the world or the market or anything because it's too hard. But I just think that it's anyone who's looking for a home should at least get an assessment to see where they sit, and the sooner you can get into the market, the better, regardless of the situation. Interest rates are a bit scary, but it's all about building wealth and capital gain, and that's why why it's so important to get into the market.
Cool. All right.
No more questions. No more questions yet, Rupert.
We've had lots of thanks from and lots of highs from everyone. So yeah, thanks for everyone for watching. It's been some great questions on there. Yeah, but that's probably the end of them for now.
Yeah, that's good. Hey, look, everybody, thank you so much. Everyone who came in and watched or watch us in the future. Hope they get something out of it. Really special thanks to Kate, Tyson, and Dan. Really, really appreciate your time. If anyone needs any help, client-wise, they know where to come.
Thanks,
Rupert.
Right, we'll wrap it up.
Thanks for having us.